Today, the book I will explain to you is The Psychology of Money, subtitled Timeless Lessons on Wealth, Greed, and Happiness. The author of this book, Morgan Housel, was once a financial columnist for the Wall Street Journal. This book was published in 2020, and the author is considered very thoughtful, saying there is substance in this book. Why? Because Housel's characteristic is that he likes to discover the immutable laws of human nature from vast historical data. Then, through these laws, he examines their contemporary relevance. This book, The Psychology of Money, is very beneficial for us to optimize our money decisions and understand the economic environment we are in now. Even understanding some of the principles discussed in the book is more beneficial than gnawing at many specific investment and financial guidance books. Why? Let's start with one thing from the book. We know that the investment guru Graham wrote a book called The Intelligent Investor. Many people call this book the Bible of investing, which not only contains theories but also provides many actionable formulas. Author Housel read this book when he was young, his first encounter with knowledge about investing. He was deeply attracted by the investment formulas in the book, feeling as if just by following these formulas, one could become rich. However, as his investment experience grew and his understanding of investing deepened, he realized that you can't apply the formulas and specific guidance from the book to investing. For example, one of Graham's criteria was that conservative investors should not choose stocks trading at more than 1.5 times their book value. However, in the U.S. stock market from 2010 to 2020, if you strictly adhered to this criterion, all you could buy were insurance and bank stocks. That is to say, the applicability of this rule had already become poor. Moreover, if we carefully trace the revision process of The Intelligent Investor, we find that between 1949 and 1972, Graham revised these formulas 5 times. So, was it finalized by 1972? Not really. It's just that he couldn't continue revising due to health issues after that year. Now, let's think about it. How much guiding significance do these formulas have in 2023? What about in 2050? Many of the specific knowledge and formulas in investment and finance books are like this, having great temporal and spatial limitations. Therefore, author Housel believes that we should pay more attention to understanding some universally meaningful things, such as the greed and fear existing in human nature, people's psychological reactions under stress, and the psychological healing process after experiencing stimulation, etc. Housel says he likes a quote from Voltaire: "History never repeats itself, but man always repeats the same mistakes." He believes that this saying is especially applicable to our behavior in terms of money. So he likes to look for the underlying human nature and psychological laws in the history of money and think about how we can use these findings. Today, I will focus on explaining 3 reminders given to us by Housel's discoveries. These 3 reminders can each be summarized in one sentence. Being reasonable is better than being absolutely rational. To survive long, maintain a safety margin. A person's way of managing money is shaped by their past experiences. These 3 sentences sound simple, but as we gradually unfold them, you will discover a deeper meaning. First, let's consider the first sentence. In making money-related decisions, being reasonable is better than being absolutely rational. Let's first talk about a person, the 1990 Nobel laureate in economics, Markowitz. Those with a bit of financial knowledge should know that this man holds a very important place in the field of finance. He proposed the theory of portfolio management in the 1950s, the first to put investing into a quantitative framework known as the Big Bang Theory of finance. Why so? Because before he proposed this theory, although everyone knew that investing involves risks, no one knew how to measure or calculate risk. But Markowitz's theory turned this abstract concept into a calculable variable. His analytical framework helps people calculate an asset combination that minimizes risk and maximizes returns. This combination could include stocks, bonds, commodities, foreign exchange, and so on. This theory can be said to have created the modern investment analysis industry, because before this, people felt that investing was an art. For instance, the father of value investing, Graham, who we mentioned at the beginning, was like a master artist studying individual stocks. But after Markowitz's theory came out, people knew that investing is not just about analyzing individual assets, but also about finding the best combination, requiring holistic, extensive calculation and analysis. This is also what many Wall Street elites do day and night. But back to Markowitz himself. Since he created this theory, he must have done very well in his own quantitative investment analysis, right? Did he design a diversified asset portfolio for himself? Someone actually asked Markowitz, "How do you invest?" Markowitz shrugged and said, "It's simple. I just buy half in bonds and half in stocks." Why would the father of asset portfolio design such a simple portfolio for himself? Markowitz explained, "I can imagine that if the stock market keeps falling and I have put all my money in, I would be very worried. I can also imagine that if the stock market keeps rising, but I didn't participate, I would regret it. So, my investment principle is to minimize my future regrets." So, this is very interesting. There's a saying, don't watch what a person says, but watch what he does. Markowitz proposed an absolutely rational analytical framework, and many people use it. But when it comes to himself, he discarded this framework and used another set of reasoning. Why? Because that was a choice that felt comfortable and reasonable to him. So, what counts as a reasonable investment decision for us? Specifically, it varies from person to person, but there's a saying in the book that I think is particularly brilliant. That is, in reality, a reasonable investment plan is definitely one that allows us to sleep peacefully at night. Interestingly, I once heard a financial scholar mention that when he was in school, his teacher told the students, "Remember, when you make investments in the future, your principle is not to let your position and strategy affect your sleep." This coincides with this statement in this book. Further in the book, I found that Buffett also said something similar at the 2008 Berkshire Hathaway shareholder meeting. "Even if it comes to a point where I must make a choice, I would never exchange a night's sleep for the chance to make more profits." This is also what being reasonable means to him. So, why do we say that in investment decisions, being reasonable is better than being absolutely rational? Simply because being reasonable allows you to persist. Absolute rationality starts from cold calculation, but being reasonable also takes human factors into account. And to persist in any strategy, you need living people to execute it, so we cannot ignore people's feelings. Like losing weight, persistently eating healthy and exercising every day is rational. You will lose weight faster, but at the same time, it is painful and easy to give up halfway. So some fitness coaches might suggest adding a rest day or a cheat day in a week, or maybe have an extra bite or two of your favorite snack at breakfast each day. One very important reason for doing this is that it is reasonable and helps you better persist. But you might say, what if some people just like healthy eating and daily exercise, then it's not painful for them, right? Exactly, in that case, this lifestyle is reasonable for them. Realizing this actually provides us with insights into formulating investment strategies. You see, many people say that in the investment field, it's hard to stick to long-termism. Encountering some fluctuations, they can't help but want to pull out. For this phenomenon, the author offers an interesting perspective, believing that many times it's because we don't like our investment targets or investment strategies enough. For example, you invested in a company because you think its prospects are good, but you neither care about nor are interested in its business field. Then, if the investment goes well afterward, you might feel okay. But once the situation takes a sharp turn for the worse, it becomes a case of you losing money on a project you are not interested in. Then you are more likely to turn around and leave, switching to other fields. But if you were initially very interested in the investment target, feeling that the company's mission, products, team, and technology are all very much to your taste, then even if its returns temporarily decline or it falls into a trough, because your belief and love for it are still there, you feel at least you are doing something meaningful with your money, then you are more likely to persist for a longer time. Also, you might have heard that many professionals suggest that for most ordinary investors, investing in a broad market index fund would yield better returns than tinkering in the stock market themselves. From a reasonable perspective, this approach is not suitable for everyone, because many people have their own preferences when it comes to investing. For example, an investor known to the author mainly invests in diversified funds, but also holds a small portion of stocks. He says that he buys stocks not because he thinks any particular stock will outperform the market, but because he loves stocks, enjoys researching stocks, and enjoys the thrill of tracking price fluctuations. For him, holding some stocks is a reasonable choice, easier to persist in. Additionally, I recall, in the book Lessons My Father Taught Me by Buffett, the stock god Buffett's son mentioned that from a young age, he saw his father engrossed in researching various companies' financial statements, looking for undervalued value pits, and enjoying it immensely. Even after making a lot of money and becoming this stock god, Buffett still stuck to his routine, wearing khaki pants and working 6 days a week, because he genuinely enjoyed doing these things. Value investing, for others, might be a philosophy that requires perseverance, but for Buffett, it was his passion. The author says, the phrase, "do what you like," might seem a bit hollow when taken out of context, like a fortune cookie suggestion. But if you use it as a strategy to allow yourself to go further on a certain path, you'll find that its effect is quite magical and powerful. Second part. Alright, in the first part we just discussed, we talked about how, in making decisions about money, being reasonable is better than being absolutely rational. Why? Because this makes it easier for you to persist. But you might ask, what's the significance of this persistence? Here, I can give you two direct answers. First, it can enhance the success rate of your investment strategy. The author of this book has summarized academic research findings, and although scholars have some differences in measuring investment performance, such as some studying return on investment and some studying the probability that an investment strategy can make money over a certain period, they have shown a relatively strong consistency in one research conclusion. That is, a very important factor affecting investment performance is whether you can persist in your investment strategy, even in economically depressed years. For example, scholars have found that in the U.S. stock market, an investment strategy has about a 50% chance of making you money in one day, a 68% chance of making money in 1 year, and if you extend the time cycle to 10 years, the probability of making money reaches 88%, and it increases further over longer periods. Besides enhancing the success rate of the investment strategy, persistence also has another meaning, which is to allow compound interest to demonstrate its power. We all know that compound interest doesn't rely on huge returns, but on the continuous accumulation of returns over a long period. Only if you give wealth years to grow can the power of compound interest manifest. It's like planting an oak tree. 1 year of growth time, it won't change much. 10 years, it will show significant changes. In 50 years, it will grow into a towering tree. This is the meaning of persistence. From this perspective, those factors that allow you to stay longer in the game are enhancing your advantage. Such factors, we mention one in the first part, which is making decisions that are reasonable. And in other chapters of this book, I've seen another factor, which is establishing a survival-first mentality. The author believes that this mentality is very important whether in investing, planning personal careers, or running a business. For example, once, the president of Sequoia Capital, billionaire Michael Moritz, was on a famous interview show, and the host asked him, "Why has Sequoia Capital become one of the most successful venture capital institutions?" This is a big question, but Moritz immediately pointed out the factor of durability. He said, some venture capital firms' success only lasts 5 to 10 years, but Sequoia Capital has managed to stand firm for 40 years. The host then asked, "How did you do it?" Moritz said he felt it was because they were always afraid of being eliminated from the industry. So in formulating various business strategies and investment strategies, their priority consideration was survival. Every strategy needed to allow the company to live longer and better, or at least not threaten the company's survival. For example, those choices that might have huge returns, but if failed, would put the company in a survival crisis, are absolutely not touched by them. They believe that being able to survive long, not being eliminated or forced to give up, is the most important thing. Buffett has also said something similar. One key to successful investing is don't leave the table. That is, at least ensure you can stay alive. As long as you are alive, you have more chances to win. You might have heard many times the story of Buffett and Charlie Munger as partners, but did you know? Actually, when they first founded Berkshire Hathaway, there was a third member in their team, named Rick Guerin. What happened to him later? It turns out, during the U.S. economic recession from 1973 to 1974, Rick spotted an investment opportunity, leveraged heavily, and borrowed to invest. Unfortunately, it turned out that Rick was wrong. He lost a lot of money and had to sell his shares in Berkshire at a low price to Buffett. Just like that, he left the table and couldn't share in the later gains of Berkshire. Regarding this, Buffett later said, "Charlie and I always knew we would become very wealthy, but we were not in a hurry to become rich. Rick was as smart as us, but he was too impatient." From Rick Guerin and Sequoia Capital stories, we can also summarize a lesson, which is, if you want to put the survival first philosophy into practice, we must first remember, no return is worth the risk of losing everything. This is also a point emphasized in this book. From Buffett's own investment strategies, we can actually see this point very clearly. He always keeps enough cash in the company's accounts, never leverages or borrows to invest, and often sells assets and holds cash just as asset price bubbles are starting to form. For example, during the 2008 financial crisis, not only did Buffett not lose money, but he also made a lot. Why? Because before the crisis erupted, he thought stocks were expensive and hoarded a lot of cash, then picked up a lot of cheap assets after the crisis, and thus made a lot. You might ask, aren't you afraid of missing opportunities by doing this? Buffett's view is, not afraid. Opportunities are always there, but the important thing is you have to first ensure you can stay at the table. The investment philosophy of the long-winning company marathon in the asset management field, stay away from bubbles, even if too early is good, actually has a similar meaning. All right, we just talked about, to put this survival-first philosophy into practice, we need to remember, no return is worth the risk of losing everything. Besides this, there is another reminder in this book, that is, to survive long, you need to maintain a sufficient safety margin. Safety margin is a concept introduced by the investment guru Graham. The author of this book believes that this is a very wise way of thinking that we should pay attention to. What does safety margin mean? Very simple. For example, you think a company is worth $10, but its current market price is $9. You decide not to enter the market yet and wait a little longer. 2 days later, the market suddenly offers a price of $7, then you decide to enter the market. Then the $3 discount compared to your expected $10 is your mental safety margin. Maintaining a safety margin means setting this number as large as possible. For example, still the same company, you think it's worth $10, then enter the market at the market price of $9. But later the market price falls a lot, dropping to $6. At this time, your mindset might be very unstable. But if you keep a bigger safety margin, entering at $7, the loss will be much less. Keep even more, and maybe you haven't entered the market yet, thus no loss. So, in investing, maintaining a safety margin can be very direct. For example, no matter how much you value a company, it's best to discount your mental number by another 50 to 60%. Wait for it to reach this low point, then consider buying the stock, which is also the experience many value investors have gained over many years of trial and error. Of course, the idea of maintaining a safety margin is not limited to investing. For example, in personal financial planning, the author gives an example. Suppose you expect to earn 8% on your investments every year. Should you then base your future financial plans on this number? Better not to. A better approach is to discount your expectations and make plans that can be achieved even if the return rate is only 4% to 5%. In life, safety margin has many forms, such as a more relaxed time schedule, plans with flexibility, contingency plans for unexpected situations, and always budgeting with a surplus, etc. The author says that many times, our plans fail not because we misjudge the direction, but because we didn't maintain enough safety margin. Just like many people correctly predict the long-term trend of stock prices, but because they didn't keep enough reserve grain on their books, they fall in the short-term fluctuations. In short, living in a world full of uncertainty, where black swans appear from time to time, no one can guarantee their predictions are always right. And maintaining a sufficient safety margin is about giving our survival enough room for error. Even if we make some mistakes, we won't be disastrously out of the game. Third part. All right, in the first and second parts we just discussed, we mainly talked about two reminders this book gives us, which are, being reasonable is better than being absolutely rational, and, to survive long, you need to maintain a safety margin. Next, in this part, we will talk about the third reminder, which is very helpful for us to understand others' behaviors and environmental changes. That is, a person's way of managing money is shaped by their past experiences. The shaping effect of experiences is very common in life. For example, people who grew up in poverty and didn't eat well as children often have a greater interest in eating when they grow up. People who have been betrayed in relationships tend to be more cautious and suspicious towards their partners, and so on. In dealing with money, the shaping effect of experiences is also very evident. For example, research has found that those who made money as soon as they entered the stock market are less willing to cut losses and stop losses when they encounter losses later, while those who lost money as soon as they entered the stock market are more likely to admit their mistakes and stop losses in time when they encounter losses again. In 2006, two economists from the National Bureau of Economic Research in the United States conducted an in-depth study of Americans' financial management styles. They found that people's investment decisions throughout their lives largely depend on their life experiences, especially their early adult experiences, that is, their experiences in their 20s. This is relatively easy to understand, because at this age, people are just starting to handle money issues independently and are just beginning to form a perception of the external economic environment. For example, these two economists found that if a person experienced very high inflation rates when they were young, they would invest less in bonds in their later investment career. If a person was young during a boom period in the stock market, they would invest more in stocks in their later investment career. The Financial Times once interviewed a famous bond manager, Bill Gross. Gross said that if he had been born 10 years earlier or later, he might not have been doing his current job. Because when he was young, he just caught the time when interest rates plummeted and bond prices soared. This greatly influenced Gross's view of investment opportunities. In his view, bonds were like money printing machines. But Gross's father, who grew up in a high inflation environment, did not see bonds as money printing machines, but as wealth crushers. Okay, we've further understood through some examples that a person's way of managing money is shaped by their past experiences. So, what practical insights can this statement give us? I think there are these two sentences. The first sentence, what's unimaginable to you, might be reasonable to someone else. From the narration just now, we should be able to clearly feel that people of different birth generations and growth experiences different social and economic environments, and even different luck all cause them to have significant differences in their perceptions and attitudes towards investment and money. Because this is the case, sometimes when we see someone's financial decision, we might think it's very irrational, but actually, from their own experiential perspective, it might be reasonable. And if you try to persuade them to change their thinking, it might also be difficult because everyone is more willing to believe their own personal experiences rather than someone else's persuasion. The author believes that in the matter of money, very few people truly lose their reason. It's just that each person's reason is a bit different. Another insight, which we can extend from this part of the book, is the environment is a fast variable, but the human heart is a slow variable. People who have experienced earthquakes or floods will be more cautious. People who have experienced recessions will tend to reduce consumption and increase savings. People who have experienced business failures and unemployment will be more reluctant to take risks. The shocks come and go, but the traces they leave in a person's heart will last a long time. In the late 1990s, around the time of the Asian financial crisis, people observed that cash holdings as a proportion of assets in enterprises in 8 East Asian countries rapidly increased. Why? Because cash is king, an experience entrepreneurs learned during the crisis. And 10 years after the crisis, the cash holdings of enterprises were still twice the level before the crisis. Is this because people in East Asia are more conservative? No, East Asia is not an exception. Similar things have happened in many countries around the world. For example, after the 2008 financial crisis, the savings rate in the United States continued to rise for 10 years, in the United Kingdom for 6 years, and in the European Union for 4 years. The scar of a giant economy is made up of countless micro-individual scars on people's hearts. The shock comes and goes, but the scars it leaves need time to heal. And during such a period, people in the economy, while healing their own inner wounds, undoubtedly also need to adapt to this external recovery period. How to adapt? For example, personal investment decisions should adopt a guaranteed thinking, diversified configuration approach. Diversified configuration means, under possible conditions, making your asset categories, currencies, investment durations, and investment methods more diversified. Guaranteed thinking means that part of your assets should be used for the baseline, not weighing too much on returns. Some people bought quite a lot of physical gold around 2022, as well as protective insurance products. These decisions are not for returns, but for guarantees, to build a safety net for personal wealth. Moreover, for example, in terms of business operation, we talked about in the interpretation of the book, Small is Beautiful. In a period of slowed growth and increased uncertainty, blindly pursuing corporate scale expansion is likely to make the company big but weak. In such a period, the species that can survive well are likely not to be behemoths like dinosaurs and whales, but clever species like sparrows that can quickly find new ecological niches. In short, in an environment that has experienced shocks and is healing scars, whether it's a city, a company, or a person, all need the power of healing. And what we can do is to hold a tenacious heart, to understand the new climate conditions, the new soil environment, to adapt, to survive, to evolve. Although the human heart is slow, time is long. In conclusion, these are the key contents of The Psychology of Money that I wanted to share with you. I hope today's narration will help you understand wealth, understand the human heart, and understand the economic environment we are in. You can also share this book with your friends. If you like the content of Daily Book Dive, click the subscribe button to stay updated. Your encouragement helps us continue bringing book essence to our community. Congratulations, you've finished another book.